your tax needs and more. Later CPA's the one you adore. Later CPA and Associates, accounting done great by mates.
Hi there, I'm Daniel Later, founder of Later CPA, and welcome back to our ongoing series, Tax Strategy, right here, right now, where we are talking about great ways to reduce your tax bill and skipping all the jargon. So today's presentation is going to be about entity choice to reduce your self-employment tax, Schedule C versus partnership versus S-Corp. Now, a lot of practice owners are asking, should I stay as a sole proprietor, become a partnership, or elect to be an S corporation? But the real tax question is usually this: which entity gives me the best chance to reduce my self-employment taxes? Now this matters because entity choice can affect how Social Security and Medicare taxes apply to your business income. So today's goal is we are going to be talking about the big picture differences between the Schedule C, the partnership, or the S corporation entity choices. And to help you understand when an S corporation may reduce your self-employment tax and when it may not be worth the extra work. Now, why does this matter? Self-employment tax is a major cost for many private practice owners. The IRS says that you generally owe self-employment tax if you have more than $400 of earnings from self-employment. And the IRS also says that the self-employment tax generally applies to 92.35% of your self-employment earnings. So the way your entity classifies your earnings can make a big difference. So let's talk about the three main options. First, a Schedule C or a sole proprietor. Now this is the simplest option. A sole proprietor reports business income directly on their personal tax return. This is a single member LLC. This is a unregistered, non-established business. This is your contractor business before you've registered with any state. Now, in general, the net profit from a sole proprietor Schedule C is subject to the self-employment tax. That means more of your profit is being applied to that self-employment tax. There is no difference or distinguishment between salary and distribution. It's all applied to your self-employment tax. Now, a Schedule C is the best fit for a new practice if you have low or inconsistent profits or you just want to be simple. Then the Schedule C option is best for you. Now, moving on from that, the next option that we're considering is the partnership, sometimes called the LLC or multi-member LLC, but we'll call it a partnership just to be clear here. Now, a partnership is what is most often used when there's two or more owners. Now, a partnership does not itself pay any of the income tax. It does not. It's considered a pass-through entity and does not pay income tax. But instead, all those profits go down and flow to the partners. But for self-employment tax, any active partners are treated as self-employed. Now, the IRS says that partners who are not also employees or some other combination of that generally must be paying their Social Security and Medicare tax through the self-employment. So the partner's status, if they're actively participating in the business, is what identifies and creates self-employment tax for them. Now the partner option is best if you have multiple owners, you have an ownership structure, and you have a legally registered business. That's it. Those are the reasons we want to use the ownership structure. In my opinion, it's not the best. Clearly, there's other better options that help reduce self-employment tax further, and we'll talk about them. But it is an option if you are in the position to utilize it. Now, let's talk about what I think is the best option, but not best for everyone. This is the S corporation. Now, an S corporation does not create self-employment tax. Simply put, it does not. Now, the S corporation is still a pass-through entity, meaning any income it creates passes through to the owner, and the owner is taxed on that income. But again, the S corporation does not pay any self-employment tax. Instead, what they're required to do is they're required to pay to the owners a reasonable compensation on a W-2. That does create payroll taxes like the Social Security and the Medicare taxes. Those are handled through your W-2. Now, the IRS says that an S corporation must pay a reasonable compensation to the shareholder employees before they're allowed to take distributions or non-wage distributions from the company. Again, those wages are subject to those payroll taxes, but any additional profits that the S corporation has made above that reasonable compensation or wage amount, any additional profits can still be distributed to the owner. Now, these additional profits are not subject to that self-employment tax, and that's where S corporation creates the savings, those additional distributions. Now, an S corporation is a strong fit when your business has steady profit. You have an owner who is actively working in the business. The books are kept up and clean, and you're willing to run payroll and handle the extra compliance requirements for an S corporation. If you do those things and if you meet those requirements, the S corp is perfect for you. Now, just to give a quick, simple comparison between those three options we talked about. The Schedule C, it is the simplest, but most or all of the profits is exposed to that self-employment tax. The partnership, it's only a tiny step up from the Schedule C. It's most useful when you have multiple owners, but those owners, the active owners, are still paying self-employment tax on their earnings from that partnership. The third option is the S corporation. It does require more compliance, more work, more cost, but it reduces that self-employment tax if there's enough profit above the reasonable salary you've picked. Now, a couple common mistakes to spell out so you're aware of them. First off, the S Corp, it does not avoid all tax. That is a huge misconception. It helps with reducing the Medicare and Social Security taxes. It doesn't eliminate them, and it doesn't touch the income tax. So S Corp reduces tax, does not avoid or make things tax-free. The second mistake to think about is not every practice should become an S corporation. If your profit's too low, then the extra administration, the extra cost, the extra time is going to wipe out any tax benefits you might get. Third mistake is thinking that a partnership works like the S corporation. It does not. How an S corporation pays its owner is very different than how a partnership pays their owner, and the effect that has on their self-employment tax. So remember, partnership is not the same as an S corporation. Fourth mistake worth spelling out: when you set your S corporation reasonable salary too low, this creates a red flag with the IRS, and they may look at your wages and say that's unreasonable and reset it. And that's not an audit you want to be stuck in. So, a couple practical takeaways to take away from this. Again, the Schedule C, easiest. A partnership, it's still pretty easy. It's good for multiple owners, but it does not create real good tax savings. The S corporation, most complex. Not super complex, but far more complex than a Schedule C. But it does create that tax savings with the reduced self-employment tax. Now, a couple closing thoughts. The best entity for your business is not always the simplest one. And it's not always the one that sounds the most advanced and potentially could save you the most. The right entity is the one that balances your tax savings, your compliance requirements, the administrative work, and your long-term goals. You got to consider all of them. Now, a critical thinking question for you. If your practice earned twice as much money next year than it had last year, would your current entity still be the best fit? Or would you be paying more in self-employment taxes than necessary? Next week, we are going to be talking about reasonable compensation for an S corporation owner. So don't forget to like, follow, and subscribe for future events and tax advice. Visit our website, latercpa.com. Have a great weekend. Keep helping others to help themselves, and let us help you to do just that. I'll see you next time. Bye.
For all your tax needs and more, Later CPA's the one you adore. Later CPA and Associates, accounting done great by mates.